Major funding for these broadcasts has been provided by grants from New York Community Bank, M&T Bank, PBM, Customers Bank, Collins Building Services, AmTrust Title Insurance Company, Marks Paneth, Capital One Bank. Additional funding for these broadcasts has been provided by grants from Amerant Bank, Bank of America, Citizens Bank, Dime Community Bank, Douglaston Development Levine Builders, Flushing Bank, Friedman LLP, Handro Properties LLC Handler Real Estate Organization, Hodges Ward Elliott Inc., Investors Bank, James D. Kuhn Real Estate Institute at Syracuse University, John Catsimatidis Red Apple Group, Keysight Capital Partners, New Banks, Meridian Capital Group, Ocean First Bank, People's United Bank, RPW Group, TD Bank, and these friends. $5,600 pages? I didn't read all of the act. I wrote most of the synopsis, but the gentleman over here today participating on my panel had the 5,600 pages to read. And fortunately, last night he signed the act. So today I brought together 3 tax specialists who understand the Consolidated Appropriations Act of 2021, also called the Accountants and Lawyers Act, because everybody in the accounting and the legal profession are going to be there to answer some of the questions. My guest today includes Mark Barron, who is a principal at Marks Paneth LLP, Mike Greenwald, who is a partner and tax director at Friedman LLP, and last but not least, Abe Leitner, who is a director at Goulston and Stores. So who of my group today sat down and read the 5,600 pages, or did you have your associates read the 5,600 pages, or both? Okay, Mike, I knew you did.
Yeah, so I actually read about 500 or so pages. I picked out the parts I needed to read. It's funny, I had the printout sitting on my desk at home, and my son, Michael, who's a second year at Columbia Law, came in and asked me what I was reading. So I told him this was actually just an excerpt from this nearly 6,000 page bill. So he looked down at the pile and said, "Oh, it's double spaced."
You know, that's what I tell, my staff and my partners. I said, yeah, it's 5,600 pages, but if you turned this in college, your professor would kick it back. They use very large font. They skip a lot of spaces. They use wide margins. So, to us, it's 5,600 pages, but, maybe it's 3,000 pages in real life.
So here's my initial question. What are the most important portions of this act? Okay, because as I said, I've read probably 100 pages of different synopses, including earlier this morning, the Wall Street Journal, a couple of other professional firms and associations. What do you see as the most important elements of the act? Abe?
Sure. So there are non-tax portions and tax portions, I guess I'd start with. From a non-tax perspective, probably the most important one is the extension of the second draw of PPP loans, which I'm sure we'll talk about. There's also, and this is sort of a mix of tax and non-tax, an additional rebate that's going out to taxpayers, which is technically under the code, but doesn't really work that way. And then, of course, there's an extension of unemployment benefits, which is very important to a lot of Americans. On the tax side, the bill actually includes 2 separate tax acts. One is called the COVID-related Relief Act, Taxpayer Relief Act of 2020, and the other one is called the Taxpayer Certainty and Disaster Tax Relief Act of 2020. And they both include some COVID-related aspects and also a number of things that have nothing to do with the pandemic, just general tax relief. Probably one of the most important tax provisions in here is a broad expansion of the wage retention credit, which was included in the original CARES Act, but in a much narrower form.
Would you explain what you mean by that extension?
So the original CARES Act included a credit to incentivize employers to keep employees on their payroll. And the credit was fairly narrow to the point where I'd be curious to hear what Mike and Mark have seen, but very few of my clients actually were in a position to take advantage of it to any extent. Essentially, it was a credit of $5,000, up to $5,000 per employee. But in order to take advantage of it, first of all, you had to meet strict standards. Either your business had to have been actually shut down, or you had a 50% reduction in revenue during a quarter as a result of the pandemic. In addition, you couldn't take advantage of it if you were taking any PPP loans, which eliminated the vast majority of small businesses. It was also fairly limited dollar amount. And in addition, for businesses that had more than 100 employees, you could only claim the credit to the extent that you were paying people who are not coming into work. So for larger businesses, it wasn't really that useful because most businesses who had employees not coming into work wanted to stop paying their salaries. So it was really a very narrow targeted provision. In this new bill, among other things, you can now claim this credit even if you took PPP loans. So that's a huge expansion.
Now, is that available to anybody to get the credit? Because I do remember the difficulties on the initial one. Is Friedman, is Goulston, as Marks Paneth able to take the credit for your employees today?
First of all, you still have to meet the test that either you were closed down or you had a reduction in revenue. And
I understand,
So-
but let's say you had a reduction in revenue. Okay,
right, so now if you have 500 or fewer employees, you can take the credit, even for employees who were not, staying home because they couldn't come to work or because you didn't have any work for them to do. The point that Abe was making, and that's really an important point, is that you can now take it if you had a PPP loan. The problem is you can't take it with the wages that were paid with the PPP loan proceeds. And as it stands right now, we don't know how to distinguish that. We don't have any guidance as to how you segregate wages between what's paid for with the PPP loan and what's now eligible for the retention credit. So there's still going to be some confusion out there for taxpayers to determine whether or not they're actually eligible to take the credit. We've had some clients apply for PPP loan forgiveness. And so the question's been, well, how much do I put down? Do I put down all the wages? Do I put down all of the expenses that qualify, just to make sure in case anything got knocked out? Now the question is, do I segregate those? Do I identify specifically whose wages I'm including and whose wages I'm not? So, we're still not clear as to how these provisions are all going to mesh together.
Mark, what other tax ramifications do you see as benefits under the new act?
Oh my gosh, well, it depends on where you want to begin. There's tax ramifications and Mike were discussing on the employee retention credit, which clearly is going to provide an immediate benefit. The tax bill, as you know, and is large, has a number of different parts to it. The parts that deal with tax, when you ask about the tax implication, really depends on where you are. So if you are a PPP borrower, for example, you now may have an opportunity to take advantage of the employee retention credit, which is extended until June of next year, could be an additional $14,000 per employee for the 2 quarters.
14,000?
That's right. It could be up to 14. It's up to $7,000 per employee. So for 2 quarters, that would be $14,000.
I want a clarification on this point.
Mhm.
Let's say I have a friend or a client who got a substantial amount of PPP money. He laid off his employees because there's no business today. Okay. Today, he's a smaller staff than he had before. He got the PPP money. We'll talk about how they get the loan approved. Okay. Right now, he can take a credit as much as 14,000 per employee is what you're saying?
Well, as Mike was discussing, money is fungible. So we need to know how to implement this rule. We need to know how and when the money was used, how you can apply it toward each employee. You cannot take a benefit for a PPP forgiveness and the employee retention credit at the same time. So if you have employees that you've laid off, you need to have employees on your payroll in order to take advantage of the credit. So there's a lot that remains to be seen on how to implement this program. But there's no question the intent of Congress here in providing the tax benefit is so that more employers would be able to benefit from this credit and have a lower threshold on which to take the credit. I think it's going to be much more important now than in the future.
What are the major implications for a real estate company with regard to the new act? Mike?
Well, I think there's a couple of things with respect to real estate companies. One that's tucked in here. And one of the things that you have to realize about this act is that it's really a bunch of little acts that all were in Congress before this bill was passed. So if you look at the titles, each section has its own title because they pulled a whole bunch of separate bills. So one of the bills that they pulled into this is something that's been debated for a number of years, but there's now similar to the 9% low-income housing tax credit, which is set as a floor of 9%. The 4% low-income housing tax credit for acquisitions and tax-exempt bond financing, that's also now a floor. It used to actually go below 4%, which was a problem for a lot of developers, but now they've set that as a 4% floor. So that's a bonus for real estate in the new bill. There are provisions, with respect to being able to take other deductions that were paid for with the PPP loans. Part of the problem is going to be we don't really know how that is going to work yet. But remember, the IRS had said that they weren't going to allow deductions for expenses paid for with the PPP loans. It's not just for real estate, it's for everybody. So now you're going to be able to deduct those expenditures that you made during 2020. And that's going to be a big benefit as well.
Now, what happens to a company who wasn't in business in 2019? A new restaurant, a new business, can they qualify and get a credit for the PPP?
Well, obviously they had problems getting the original PPP loan, but our provisions now for them to get second draw PPP loans. There are special provisions for new businesses to be able to qualify.
With regard to their, the eviction and the payments to landlords for people who have been paying rents, who wants to discuss that point?
There is an eviction moratorium in this bill.
It was a CDC rule that prohibited evictions, and it's my understanding that was extended under this bill to a
But
later.
it doesn't come with money. It just says you can't evict people. It doesn't come.
No,
with
I
money.
believe I read this morning, it does come with money.
Well, there's an authorizing provision that provides funds, and I forgot which agency it provides it to, but it provides funds on which to support.
Right, but they have to come out with regulations on how to get this money out there. It's not like the PPP loan that you can just go to the bank and draw funds.
Right.
And we look at what happened with the Main Street lending program. I don't hold a whole lot of comfort from the fact that yes, there's authorizing funds, but there's actually administering the funds is a separate and second thing that somehow
Now,
the government doesn't quite seem to be able to get to work.
I was trying to get a banker who had been involved, a couple of bankers, with the first program. And I said, since you were active in the first program, I'm assuming, which I shouldn't have, I'm assuming that you're going to be involved and participating in the second PPP program. 3 lending institutions basically said to me in confidence, and I won't mention who, we have no desire to get involved with the new program. Same manner as what Mike just brought out with the Main Street lending program and other things.
I find that surprising because the legislation does have a hold harmless provision for banks.
It's,
And it's
the comment, Mark, was it's not the hold harmless. It was the question that the rules change all the time, and to educate their people, that's the biggest problem over there.
And the issue that we've been hearing with most of these programs is the cost of administering it internally inside the bank is just enormous because, as Michael said, the rules are changing all the time. So just trying to keep up with, what the government expects them to do. Yes, they won't be held accountable for it, but there's still a cost of administering it, which, has been driving the banks crazy, and the fees aren't high enough to cover it.
From a practical standpoint, the Treasury Department is probably going to pressure a lot of the larger banks to get involved again. And also the legislation has earmarked billions for these smaller institutions to get more money out to the so-called hard hit areas, and CDFI and other types of financial institutions, farm credit institutions. And I think you're going to see a different type of lender perhaps this go around.
There's a question of clarification on the cooperative apartments. I believe that the new act states that if a cooperative apartment building has less than 300 employees, they can apply for a PPP. Is that correct?
Yes.
Yes, in fact, they expanded the types of new eligible borrowers pretty significantly. And I'm glad you asked that. It does include housing cooperatives, newspapers, FCC license holders, 501c6 organizations. And there's, of course, some restrictions on lobbying activities and amounts and what you can do. And what I found really interesting is that ineligible entities include those that are owned by a Chinese entity or a Chinese resident. There's really interesting restrictions and or expansions as well.
Abe, you do a lot of international work. What effect does this have on some of your international clients?
Well, I think that the only significant change on the international front is the one Mark mentioned, which is very interesting politically, that the Congress chose to send that message specifically to China. And it also includes any company that has a resident of China on the board of directors of the company. So
Right.
Kind of a shot across the bow, I think, warning to companies that they should hesitate about who they bring in as investors and who they allow on their board.
Who would like to take the question with regard to the 25% or the 35% to apply to qualify and get PPP money as compared to 2019 compared to 2020 expenses?
Oh, with the new restriction, I mean,
Right.
I could address that as well. That this new restriction has, a comparison of your revenue in certain quarters in 2020 to 2019, and if you've had a reduction of 25%, then you would qualify for.
Is it a quarter or is it a month?
I think you're able to select a quarter. And there's some special rules for seasonal as well. So
I think you're referring to the wage retention credit.
No, it's the second round of
Right.
PPP loans.
It's a second draw
25%.
loans.
You can pick any quarter in 2020.
Right.
And if you've had a 25% reduction.
Now, also on that point, it's up to 35% if it's a hospitality type of business or a lodging or a restaurant or an allied industry, correct?
No, it's still 25%. What I think you're thinking about with the hospitality and accommodations is that they can get 3.5 times payroll as opposed to 2.5 times payroll for the amount of the loan. The question we have is, over what period of time, and Mark, maybe you've got some insight into this, over what period of time do you have to expend the funds? Because originally there was when I was first reading a draft of the bill, there was a September 30th date in there, but that seems to have fallen out in the final version of the bill. And the only date I can find is March 31st. And
March
I'm trying to
31st.
figure out how you would spend, if you've had 3.5 times payroll, but you can't pay anybody over an annualized amount of $100,000, how you would possibly spend, and you had to spend 60% still on payroll costs. how you could mathematically work all that into a 3-month period or less. So just trying to figure out, how it's going to work.
Abe, any thoughts on that?
Yeah, my reading was that you actually have 24 weeks to spend the money when it comes to forgiveness.
There's
Well,
language in there that says the covered period for the new loans is ends March 31, 2021. So it's just, but again, this was a bill that was drafted last October by Senator Collins and Marco Rubio. That just got, grafted onto this bill. So that was the date that they had in there, assuming that it was going to get passed last October, which would have given you plenty of time. So
Okay.
I don't know whether either of you guys saw anything different about.
Well, the only confusion is the part where borrowers are now allowed to elect any time in between 8 weeks and 24 weeks on which to period. But you're absolutely right. I did see that date as well, the end of March, and I don't know if that was an oversight or not.
For my audience, could you use a hypothetical company and discuss the amount of the amount that one would qualify for PPP, so we can put money apple to oranges to explain it?
Well, we could take some the clients that we all probably have, clients who have been have already had a round PPP loan. Maybe the typical borrower has not yet applied for forgiveness. They're in the process of doing so. They are doing tax planning for the end of the year, which is very important now. It's going to be a very busy time of the year. And they're going to need to know what estimated tax to pay, what deductions are available. Even though the law allows for deductions right now, it may be a suspended loss. There's a lot of planning that's involved. But in terms of a PPP loan, if you have less than 300 employees, and then you can find those quarters that we discussed, that Mike and I talked about the 25% revenue difference from a previous quarter, and you find a lender willing to loan in this market, and you have up to $2 million, I believe, and there's probably some exceptions for the restaurants and how you measure that.
It's $1.5 million to $2 million for the restaurants.
So we're going to be looking at how much it can be borrowed, what covered period, what amounts are going to be needed. And so a typical borrower, let's say it's a restaurant, is going to say, look, we've been hit hard, or somebody on Broadway. What do we do? Do I bring my employees back? I can't tell you the number of calls, I'm sure Mike and Abe have too, of clients who call constantly with what if. And there's not always clear answers, but we can find some guidance. But now the floodgates are going to open. I'm curious to see whether banks are going to be ready to go if the guidance is there, what expenses are available, what amounts that can be used, and when and how fast we can get the money. So this typical borrower, a restaurant, if you will, is going to be looking actively for funds, and whether they not only qualify for the funds, how much they're going to get, and how does this work from it.
But here's my question. The initial act, you were supposed to use the money to hire people, to employ them. Now, 9 months into the pandemic, these employees may not be with you, but you had the reduction. There's no question that you had the reduction of 25% or 35% in your revenues. So is this a gift to the company, or do they have to use it to hire employees? What do they have to do to get the money? Or is it a gift that they can keep in their pocket?
Well, clearly it's still intended to be for paychecks. It's still intended to at least have, as far as we know, 60% of the funds used to pay employees. And so presumably these companies, and a lot of them still do have employees that are on payroll that they've been carrying. They may be on furlough right now, that they could bring them back and put them back on payroll for a period of time to use the funds and try to keep going. One of the things that's in the bill is that the SBA had 10 days from the date of enactment, which I suppose is yesterday. So they have 10 days now to draft regulations implementing these new changes to the PPP loans. So we're going to get a present right after New Year's with a whole bunch of regulations from the SBA implementing all these changes. and telling us what it means. We talked a little bit about the second draw loans. There's also a whole provision in here to allow certain borrowers of first draw loans to go back and get more money. For example, if you had a business that was set up as a partnership, and because of all the confusion at the beginning, you put in for a loan based on what you pay your employees, but you didn't include anything for the partners because it wasn't clear that they were allowed to. You can go back and get money now for the salary equivalent of the partners up to $100,000 annually. The question is, are the banks going to be willing to do that work? I don't know that there's any new money in there for the banks to do it, although the law says they have to. Do the borrowers have to recertify that they really needed the money? So is there going to be a recertification of need at that point? And what else is going to go into, the additional draw on these first draw PPP loans? So we have all of this stuff to unpack, and the SBA has 10 days, including New Year's Eve and New Year's Day, to draft regulations telling all of us, how it is we're going to interpret this.
Okay.
So it's going to be
So
fun.
what we're going to do now is wait and take care of the second part of the show, which will air the week later, because we haven't even touched all the points on the PPP and the programs and the tax ramifications and so on. So I'd like to thank Mark, Mike, and Abe, and I'll see you next week.